Hey everyone, this is a trader investor. In this video we are going to talk about down markets and how can you take advantage of them at various points throughout the journey. And it's not always picking the top, it's not always picking the bottom, but how can you take advantage of down markets? Even if you want to take bullish positions in a down market, where do you take them and why do you take them and where do you potentially set up for an exit? These are very important questions to answer, because every time we enter a position we have to have a why. Why am I entering this position? It should not be, oh, I have a gut feeling it's going to do XYZ. No, it's I am anticipating price to do XYZ because the chart is telling me this, right? Because the chart is setting up for this reason, whatever that reason is in your analysis, right? And so when I say whatever that reason is, I don't mean haphazard reason. Based on your analysis, you have a narrative, and when that narrative works in your favor, you take a position, because the idea is to stack the odds in your favor. And when you stack the odds in your favor, even when you're wrong, you'll only be wrong a small percentage of the time. And that's because the markets are not predictable. We cannot never say I'm 100% accurate on my entries, I always win. It's not possible. The markets do what the markets do. For us is to anticipate what they're about to do next and stack the odds in our favor and take the position accordingly. So that's what I want to talk about today, is specifically in the SPYs, because there were a couple of positions, opportunities that really came into the picture. And as most of you know, in my videos, I subscribe to Fibonacci Retracement as part of my guideline whenever I enter positions, and I use supply and demand zones very heavily. I will add the Strat trading, the three scenarios, the one, the two up, two down, or the three. These are the three different scenarios. I'll use that. But I don't use them blindly. I don't use them just because the Strat says this is an actionable signal that I take it. No, it has to align. There has to be a confluence with the rest of my analysis. Are we in a downtrend? Then I only take a downward position, or I might take a counter trade position for a very brief moment because I see something. And then am I at an area of value? Area of value is something that I discuss all the time. The most important part of your trading is an area of value. You don't enter a trade in the middle of the trend. You enter it when that trend gives you an opportunity in terms of a short-term rally in cases of a bear market, or it gives you a short-term pullback in the cases of a bullish momentum. So in that context, we have seen, when we draw our Fibonacci retracement, we have seen that the 78.6 retracement was rejected, and so this downward pressure that started a while ago, right at the end of December, we started going down. So that downward pressure that just keeps going down, is, as long as it's not making higher highs, we're going to assume that the downward pressure has not ended. So every time we do our retracement, this is how I draw my retracements. I do my retracement. We held at the 70%, we pulled back, then we could not break through the 78.6% retracement. From there, it was a down market again. So very key to recall that. We're going to bring it to current. And so the last time price really rallied after this downturn, it created a demand zone, right? That this area of consolidation, as price found a bottom and it starts to move up from that bottom, that consolidation area is our demand zone. Multiple demand zones get created on the way up. And as we come to those demand zones, we have decisions to make. And so just to clarify, if you are new to demand zones, right, here's a consolidation on the way up when price came down and it created this demand zone, how I use the demand zone is next time price comes down there, that's my buying opportunity. A supply zone, next time price comes up there, is my selling opportunity, depending on the broader market direction, right? I'm bullish when the overall market is bullish. I'm bearish when the overall market is bearish. In this instance, though, we are bearish, but slightly bullish for a short period. But we know the 78.6 was rejected, right? It almost created a double top. It got rejected. And so when we came back to that demand zone, I'm not in a hurry to enter this position because there was a rejection here and I want more of a confirmation. What do I mean by more of a confirmation? We come down to demand, we start to make higher highs and higher lows from that demand. That's what I mean by confirmation. Unless we have that, then there's no entry. So we came down, we attempted to make a higher high, but then after we made a higher low, we never broke the high. So this lower highs from the long term continues. So continues, so therefore this demand zone is negated, right? It's no longer into the picture. What's into the picture is this area here of consolidation as a supply zone. This is into the picture. When we come back to it the next time, we have a decision to make, right? So I'll show you how that works when we look at the opposite side. So we pushed up, created a demand zone. We did not respect that demand zone, but we came back to the earlier demand zone. And what did price do? It immediately pushed from there. Now we don't take this position because we need to see a high, a higher low, which boom, it gave us, and then we break this high, right? That's the comfort level that we have, that we're gonna start to head back up. Unless we do that, we don't take that position to the long side. So when we come down to this demand zone, if you're a short time trader, maybe, you know, I'll go to the 5 minutes. Maybe the 5 minutes gave you some opportunities there. But it's kind of hard to see. So here, high, higher low, lower high, lower low. So again, there's not a clear, even on a lower time frame, there is no clear indication. Prior to that, when we made this high, we have a low, a high, which is lower than the previous high, and then we went a lower low. So again, because we keep going lower, there's not a clear indication. Right? Hindsight 2020, you can say, well, you know what, this went up, but did you know? Did you take that trade? Because you could have seen something similar down here when this was the earlier demand zone that I drew. You could have seen that, but it never went. So that's why stack the odds in your favor. If I don't see this is in my favor, I don't take this trade. For me, the trade comes when the recent swing gets rejected at the 50%, gets rejected at the 38.2%, gets rejected at the 23.6%, somewhere in this area, all the way up to the 78.6%, if it gets rejected all the way up there. So what I mean by that is, so we came to a demand zone, no trade to the upside, no trade, because the structure is not broken. The structure is still intact to the downside. However, this low is now a higher low. So we are respecting this low. So this is a good sign that maybe the bulls will come back to take charge. If we look at the daily, lower high, lower high, lower high, but higher low, higher low. So we're starting to form a triangle here, and so this triangle at the bottom of a bearish movement has the potential to break the top of that triangle and head up. So as long as we're maintaining this higher low, we're comfortable. but we don't take a trade, there's no trade to take. However, there's one trade that I took, very beautiful trade, because I have drawn my Fibonacci. I know my Fibonacci is drawn, and price comes to the 50% retracement. I gave this in Discord. I said if this becomes an abandoned baby, an inverted hammer, a doji at the rejection of these levels, I'm taking a put position. That's what I gave in my Discord group, and look how beautiful that was. Now, because we are forming a higher low from the 24th of February, not only that, this demand zone could be a strong demand zone where maybe they just wanted to collect more and take price up. So I took my exit as soon as we hit this demand zone. I'm not going to tell you I took my exit the last hour, because that third hour, right, the 10:30 Pacific time, when we entered this demand zone, I'm already happy with my profits and I'm gone. I could have made a little bit more, but I never look at it that way. This could be the last time where they have a demand zone is created because there's demand. So what if this was the last time that demand zone is seen? What if they have already collected all they wanted? But apparently there were more down here, and there could be some stops, right? It could be additional buying pressure, but there were some more orders down here, so they picked up those orders and went. So that's why you take your exits when it's setting up like this, right? When you're starting to make lower lows but higher lows, when you're starting to make those kind of triangles. In some instances where, you know, the low is broken, then you can ride it, right? You can take a chance and say, one more day, I can ride it one more day. And even for me, when I take those chances, I have taken most of my position off. I might let 1-2 contract ride, then those contracts can go to zero. I've still made my profit. So that's how you have to think about it. If you're only doing one contract, be happy with this exit. Don't look back and say, I could have made more. Yes, but you could have also lost. Why did I say you could have lost? Because you kept waiting. And then what happened today? We had this huge gap up. Those contracts went from $6 to $2.50, just like that. So, you know, you enter them at 5 and change, and they go to 2 and change. You've already lost your money instead of collecting some good amount, right? So maybe you've entered at 5, maybe you've entered at 3, depending on where in this bar you entered. But those really reverse quickly. Big picture, we have this low that is not tested, so we are making a higher low. We are testing this demand zone, but we're not testing this low. When you see something like this, don't force it. You have an H forming here, but the H, usually you say, can I take it to the bottom of this low at least? Yes, but not a guarantee. So I don't like to gamble with the profits that I make. Take them, go. So now that we are making higher low, we cleared this demand zone. Very, very nicely took care of this demand zone. It is done. It is no longer a demand zone for us. Now my target is 432 to 436 area on a long position. Why? Because we made a higher low and we broke the high. So to me, this is break of structure. It's short term, but it's still break of structure. And so I want to target these highs here somewhere around the 432 and change area, and then the supply zone. So if price stalls at the 432 area, 432 to 433 area, if price stalls, I take everything off. If price wants to keep going, I take some positions off here and I just let it ride, because at 78.6 could also be a point of a problem. This supply zone could be a point of a problem. Supply zone problem meaning price will go, stall, come back, go, come back, go, come back, and go from there. That's one possibility. Or it could just go, I don't care about you, go, right? Depending on who's winning the battle, the bears or the bulls. Thirdly, because we're in a bear market, right now we're in a bear market, it could be this. So all these scenarios are possible. So how do you safely trade them? When your position comes into this area, you take a majority of your profits. It doesn't matter if it's gone from there. It does not matter. You take a majority of your profits here. If you get a rejection, a nice rejection, meaning you get an abandoned baby or whatever you want to call it, you get a rejection at these levels, rejection at the supply zone, rejection at the 78.6%. When you get a nice rejection, that you come here, you get rejected here, you get rejected here. When you get that rejection, but in the form of a nice candlestick pattern, chart pattern, because in this scenario there was no single candle that rejected here, but in this scenario this consolidation was broken. That was your sign. High, lower, low, lower, low. For sure, time to enter, right? Time to enter when we broke this low, and boom, it went. Because we're in a momentum bearishly moving. You don't take a counter trend risk like this. If you're in a bullish trend and you see, oh, we broke the low, I'm going to take it to the previous low, you can get slaughtered very quickly. Because the markets could say, I'm just having a momentary breather, I'm just going to trap some short sellers and then be gone. You don't want that. So you want to be really, really careful. Same thing that happened here. Bulls got trapped. They saw one candle and almost a $9.50 candle and say, oh wow, we're going to go to the moon. They don't take profits. What happens? They go away this hour, they see it rising, they go away, do something else, they come back at noon thinking that, you know, tomorrow is the moon, but they have lost that position. Lucky for them that when it went in their favor, but it doesn't work out always, right? It doesn't always work out that way. People who took a long position here, a call position, they got slaughtered. So be mindful of those positions. Really, that's what the lesson of today. Really be mindful. So we come to an area of value, that demand zone. We prepare for a next position, meaning so we take a position here, and then we prepare to exit up here, or after we exit, we take the bearish position here if price continues to fall. If we continue to make lower highs, we take those positions. So everything is in context, not haphazardly just blindly entering. The only blind entries is when, and by blind I don't mean completely that way, but the only entries you take without knowing what's going to happen next is we come to an area of value, we have come back to test it. Could I take an entry here? Could I take a call position, put a tight stop? Yes, very risky. Maybe you do it, if you usually do 10, 20 contracts, maybe you do 2 or 3. Why? Because it could quickly turn against you. Just like we had this gap up, right? Of I think it was like in the morning, it was $6 or something gap up, 416 to 425, actually 424, an $8 gap up. So this $8 gap up could have been an $8 gap down, which would wipe you out. So be very mindful. It's better to not take a position that has gone in the direction you want and played it safe, rather than take all those trades and be wrong a lot of the times. Right? Stack the odds in your favor. I think that's the main lesson today. So for now, we have a position. We're waiting to see what that position is. This downtrend broke its own 78.6% retracement. So this the This Fibonacci is not valid, so now we're in an uptrend. We have yet to see what that does. I don't want to draw it because I don't have a pullback yet, right? I don't know where that high is to compare against for pullback. I mean, you could technically, you could just draw it and leave it there, see if there's any pullback to the 38% to take it up to the upside. But I like to have my charts simple, but this is how it's setting up. We are at the 50% retracement on the daily basis from the recent swing, high to low. We're at that 50% retracement. We're playing around that 50%. Is a 61.8 a strong resistance? Is it 70%? Is it 78.6? All of these are problem areas. That's why we are careful in these positions. It could reverse at any of these levels. I've taken a call position because we broke the structure, but knowing that it could end very quickly at any of these levels. It could even go against me, but I'm okay with that because long term I position myself to take advantage of what the charts tell me. So over a long term, being successful is what's important, not on a trade by trade basis. I know this has been a little bit of a long video, but I wanted to make sure you understood that area of value is very critical. Knowing that I am going to take a trade when I get to my area of value, then you take a trade. When you take a trade, you know your exit. Fantastic, right? I took this trade. I know my exit. 432 to 436 area is my exit. If we gap up, blow through a couple of those, fantastic. It's to my advantage. I still exit because I still have 440. That area of supply zone is still a problem for me. Last week's high, that's still a problem for me. So if I don't take profits, you can get slaughtered, decimated. If you look at oil companies, they had a nice run the whole of last week. If you had stayed in there hoping that the run would continue without a break, or if you had joined late, say, oh, I'm chasing, and now your option price are losing money because of theta decay, and we're still back where we are. So be mindful, right? Be careful, right? You enter a trade at 40 and you see price go to 56. I hope you took profits. If you didn't take profits, then this is where your account goes from positive to negative. Let's not be greedy. Let's take profits along the way. We see price up, consolidate, up, consolidate, up, consolidate, up, consolidate, up, and then it fell a little bit. Consolidated, up, fell, consolidated, up. I don't know what it's doing. Just to give you a good example. All right, everyone. Take care for now, and I'll see you in the next video.